Let's review Tuesday's market action. The three major indexes moved in different directions. We saw a clear signal from the intraday flow of funds. Capital was pulling out of tech stocks across the board. The Nasdaq dropped more than 0.8%. The S&P also closed slightly lower. Only the Dow managed to gain, rising 0.91%. Looking at the broader market picture, one thing is especially worth paying attention to right now. The market clearly shifted direction today. So where did it shift to? It moved toward the door. On the first trading day of the second half, investors clearly sold off Nvidia and Microsoft, big name tech stocks, and rotated into the healthcare sector. Healthcare stocks are so strong by interest. For example, leading healthcare stocks Amgen and United Health both rose over 4%. Each posted gains above 4%. Merck was up more than 3%. Johnson & Johnson gained around 2%. So it's fair to say healthcare stocks were the main force behind the Dawes rally. Over the past 2 months, the market has clearly shown rising risk appetite. Investors have been chasing growth-driven stocks, particularly those with strong structural themes like AI and tech. But that trend recently has lost steam in the short term. Momentum is fading, and fast. After strong gains in the first half of the year, tech valuations are now stretched, with clear signs of being overbought. So the pressure to pull back is increasing. If you look at the Nasdaq index, you can clearly sense it. Tech is running out of upside momentum, and at this point, the rally is definitely starting to lose steam. The sector is losing momentum fast. Looking at the daily chart, the KDJ indicator has been sitting in oversold territory for several sessions now. The J line has stayed deeply oversold for multiple consecutive days, so there's clearly a need for a short-term pullback. But here's what we need to understand. Although tech stocks have built up a lot of profit-taking pressure, the momentum to push them even higher is starting to fade. It's losing steam. That tells us upside momentum is weak. So yes, a pullback is needed in the short term, but that doesn't mean the trend is reversed. It doesn't mean the tech rally is over either. We shouldn't jump to that conclusion. This is just a pause, a technical correction within a bullish trend. This pullback is healthy. It's a constructive setup. When we say healthy, we mean it's part of an ongoing uptrend. It's part of the bullish continuation. It doesn't signal a reversal point, nor does it mean the rally is over. This is just a breather, a halftime break. And once that's done, the uptrend can resume. The bullish structure is still intact. So the uptrend isn't over yet. This is just a healthy break. From a technical perspective, selling pressure is clearly increasing right now, so there's potential for short-term pullback. During this pullback phase, we will likely see profit taking from tech stocks. And where's that money going next? That's a key shift we need to watch closely. It's an important signal that deserves attention because these funds have already made solid gains in tech stocks and now they're locking in profits and rotating out. So the question is, where are they going? They're not exiting the market, they're rotating into healthcare stocks. So what we're seeing now is even though the Dow hasn't broken all-time highs yet, even though it hasn't cleared the previous peaks or made new records, its trend recently has been much more stable compared to the Nasdaq and the S&P 500. It's holding up more strongly. It's showing solid momentum. Unlike the Nasdaq or S&P 500, which saw strong rallies but now show fading momentum, the Dow hasn't lost steam. Its uptrend is more sustainable. In fact, it's broken above its recent range and pushed past the key resistance. It's clearly moving higher. So going forward, the market expects that the Dow could soon follow the Nasdaq and S&P and set its own new all-time high. It's already getting very close to that level. A breakout seems likely, and it could be the Daw's turn to hit new records. It's within striking distance now, so a breakout to new highs could be just ahead. Now within the Dow Jones Index, there are certain component stocks worth watching closely. That's because capital has started flowing into the healthcare sector. And within healthcare, there were a few leaders with solid fundamentals that deserve our attention. Take UniHealth, for example. It's one of the top players in the entire healthcare sector. Its market cap is also sizable, very large. If we zoom out and look at the longer term chart, we can see its broader trend is quite clear, a steady uptrend. It's firmly in a bullish pattern overall. It's just that recently, since the beginning of the 2025, it has pulled back for technical correction, right? Most of it has been correcting, but recently that correction has started to bottom out. So the correction phase is clearly coming to an end. The downtrend momentum has mostly faded. We can clearly see that shift happening, and once the pullback ends, the stock is likely to resume its prior uptrend. This was just a mid-trend correction. Admittedly, the size of this pullback was larger than before, but it hasn't changed the overall trend structure. The primary trend remains upward. Looking at the weekly chart, that's very clear. There's no obvious sign of a full trend reversal. It's just a healthy correction along the way. And as of now, that correction seems nearly over. The bearish momentum is clearly fading. On the weekly chart, we see the red bars gradually shrinking. On the daily chart, things look even clearer. The recent daily trend showed that the MACD had already formed a bullish crossover, though the crossover was weak since it occurred below the zero line. Bearish momentum had been squeezed out almost completely, and now bullish momentum is starting to dominate. Especially on Tuesday, we saw a clear directional move. Looking at the moving averages on the daily chart, they've been tightly converging for quite a while in this region. They've stayed tangled together, which often signals that the breakout is near. What does that mean? It suggests that the stock price is nearing a critical breakout window. A key inflection point is approaching, and this breakout is clearly leaning toward the upside, an upward breakout. That's why Tuesday's strong rally stands out. It broke above the moving average cluster, and the MACD had already signaled a bullish crossover. Buyers are now in control. So what should we pay attention to? It's this particular day, May 15th. We saw a clear spike in volume here. That's a signal worth digging into. Let's break it down. Because this happened at a low point, right near the bottom. At this bottom range, the surge in volume pushed the stock price upward. You can clearly see it here. Look, this formed a long lower shadow on the candlestick, and that long shadow shows a V-shaped reversal on the intraday chart. The classic reversal signal. This is clearly a bottoming pattern. That candlestick looks like a piercing needle. Right here is a classic long tail bottoming formation. This one candlestick with a long lower wick looks like a golden needle piercing the bottom. It's a very clear bullish reversal signal, and it came with heavy volume. So what does that spike in volume mean? It shows that at the lows, a lot of capital flowed into the stock. That kind of price action tells us that market believes this stock has real value. There's value at the price, and because of that value, large funds stepped in to buy the dip. We saw that surge in volume, and this volume, if you zoom out and look at a longer time frame, you will notice it was the highest volume in quite a while, a major spike, what we call a breakout volume. In all the recent data, you won't find another day with volume even close to this one. So clearly, a lot of capital moved in here. This is clearly a strong support level. There's definite bottom fishing going on here. So in the short term, this area looks relatively safe. It's likely a bottom, a level where funds have started buying. There's a safety cushion here. If money is flowing in, it shows confidence in the future trend. They believe in its upside potential. And now the MACD is also starting to turn upward. It's reversing direction, so this deserves serious attention. In the short term, there's definitely an opportunity here. United Health clearly has near-term upside potential. It's already starting to form a bottoming pattern, and right now, market sentiment is clearly shifting toward healthcare in the short run because capital is rotating, shifting away from the previous hot tech giants, especially AI-related names. After a big rally earlier, they're now taking a breather. So as they consolidate, some funds are exiting. Where's that money going? It's heading in a new direction, and this new direction could offer a real short-term opportunity. It's a clear trend to watch. Besides UniHealth, another leader in the healthcare sector also deserves attention, and that's Johnson Johnson. Why Johnson Johnson? Because its price action has reached a critical point. That's why, aside from sharing insights on United Health, we're also highlighting Johnson Johnson because right now it's at a key inflection. Johnson Johnson chart shows it's approaching a critical price level, and where's that level? It's right around here, a clearly defined resistance zone. At this level right here, Johnson Johnson price has been consolidating. This consolidating pattern is forming a symmetrical triangle. It's a classic continuation setup. If it can break above this resistance zone, there could be a solid short-term opportunity. Chances are a breakout is likely to happen soon. Why do we say that? Because although it hasn't broken out yet, it's still trading under some resistance. On Tuesday, we saw a clear push upward, but it closed with a noticeable upper shadow. That shadow tells us there's pressure overhead. Resistance is still there, so why do we still think a breakout above this resistance zone is possible? Why are we optimistic? Because technically speaking, even though price is consolidating, on the daily chart we can see clear signs of accumulation. During this range bound phase, bulls have started gaining the upper hand. Why is that? Just look at the MACD. Previously, the MACD showed bearish momentum was dominant. You can see the strong red bars here, pretty large and obvious. That indicates heavy selling pressure. It was quite clear. But after that, the bearish momentum started fading. The bars kept shrinking. That tells us the seller were losing strength. And then we started to see green bars emerging. That buying momentum has gradually picked up. Bulls are now taking control, and the daily MACD here has just formed a bullish crossover. That crossover happened near the zero line, not below it, right around the zero axis, so it's relatively stronger. The KDJ indicator also formed a bullish crossover, and the trading volume is gradually picking up. It's rising steadily with strength. Especially this spot right here is worth our attention. On June 20th, there was a clear volume spike at the low. That suggests some bottom fishing activity. So we've got fresh money buying in, and that's what triggered the recovery. That buying interest pushed the prices higher. And take note, that spike in volume didn't happen at the top, it came after dip. After several down days, it surged at the bottom, so that clearly signals bottom fishing by smart money. And if you compare that volume with recent sessions, it basically doubled, a very strong spike clearly visible. With volume support like that, this breakout attempt has a higher chance of succeeding. If it breaks out, then that is a clear buy signal we should not ignore. And in the current macro backdrop, tech stocks are still facing short-term pullbacks, so the market will look for new opportunities. Funds exiting tech need somewhere to go. Investors need alternatives, and where the money flows, that's where the opportunity lies. Watch the direction of capital flow, and we will know where the markets are headed. Isn't it all flowing into healthcare now? Because on Tuesday, among the three major indexes, only the Dow Jones showed solid gains. It actually moved higher. So, what sector drove that rally? Check the components. You will quickly see the top performers were led by United Health, and most of the top gainers were in the healthcare space. So, we clearly need to focus on this sector. It's a one with near-term potential, and the setup looks relatively reliable. So today we focus on analyzing United Health and Johnson& Johnson. And for J&J is very clear. If it breaks out at this level, what are we waiting for? We're watching for that breakout signal. That breakout confirms a potential entry point for long position. I've made this point very clear. That wraps our quick take on the market. Hope it's been helpful. If you have any questions, feel free to leave a comment below.